So today, we're going to decode the fundamental difference between how an amateur and a professional trader see the exact same thing happen in the market. It's like we're looking at two totally different worlds, guided by two completely different mindsets. And understanding this difference is really the key to unlocking how the market actually works. It all kicks off with a question that I swear trips up almost everyone, right? This is the classic paradox that gets just about everyone. A company drops the best earnings report in its history, the news is glowing, and the stock just tanks. So if amazing news doesn't make the price go up, what on earth does? This one question, it gets right to the core of what separates the pros from everyone else.
And really, this slide just nails it. You see, the retail trader, they see the news and they react. Good news, buy. Bad news, sell. Simple. But the professional, they see the news as a tool. They're asking a totally different question. Who is this news for, and what is it designed to make them do? See, they're not trading the news itself. They're trading how everyone else is going to react to the news. Huge difference.
Okay, so let's start at the top of the market. Pros call this a distribution phase, which is just a fancy way of saying large institutions are quietly selling their shares to the public. This is that moment when everything looks and feels fantastic. The news is positive, making money seems easy, but for the professionals, this is exactly when the biggest warning signs start flashing.
All right, so picture this. Here's a textbook signal that gets amateurs super excited. A stock's been banging its head against a ceiling, let's say $100, and then bam, it finally punches through. It feels like a rocket ship, right? And that urge to just jump on board, man, it is powerful. But the pro, they're looking at this completely differently. And you gotta ask, why? Well, think about it. If you're a huge institution and you need to sell millions of shares, you can't just dump them on the market. You need a ton of eager buyers. This breakout creates a buying frenzy, which gives them the perfect exit liquidity. It's the perfect cover for them to unload their shares onto that excited crowd without crashing the price.
Okay, here's another one. And this one's a little more subtle, but it's so important. The market is just kind of drifting higher, day after day. But if you look closer, the trading volume is super low. It seems good, right? Price is going up. What's not to like?
But to a pro, that is a huge red flag. A real healthy bull market needs fuel. It needs big institutions fighting to buy in. And that's what creates huge volume. When the price just kind of floats up on fumes like this, it means the big money isn't playing. It's a hollow rally, just waiting for a breeze to knock it over. And this really just sums up the whole psychology of a market top. When everyone you know feels like a trading genius and every single trade seems to be a winner, it's usually a sign that the last buyer has already bought. There's just nobody left to push prices any higher. That feeling of total confidence, that's actually the moment of maximum danger.
All right, so let's flip the script completely and look at the market bottom. This is the accumulation phase. It's when the smart money is quietly buying everything up while everyone else is running for the exits. I'm talking headlines screaming crisis, fear is literally everywhere you look. And for the pros, this is go time. Okay, so imagine some really scary news just drops out of nowhere. A terrible economic report, some kind of global crisis, the market plunges, and that gut reaction for most people is just, get out, sell, now.
But the problem, they see all that panic selling, they call it capitulation, and they see a golden opportunity. Remember how they needed buyers at the top to sell to? Well, down here, they need sellers to buy from. The public's fear is what gives them the cheap prices they've been waiting for.
Now get this, because this might be the single strongest bullish signal a pro looks for. More bad news comes out. News that would have absolutely crushed the market a month ago. But the market just shrugs it off. It might dip for a second, but it just refuses to make a new low.
Just stop and think about that for a second. If the absolute worst news you can throw at the market can't push it down, what does that tell you? It tells you the sellers are gone. They're exhausted. Everyone who is going to panic and sell has already sold. The big institutions have soaked it all up, and the path of least resistance is now up. So you can see how both of these scenarios, the top and the bottom, they really hinge on this one key idea: trapped traders. At the top, it's the breakout buyers who get trapped. At the bottom, it's the panic sellers. The market rarely just moves randomly. A lot of the time, it moves specifically to cause the most pain to one group, because their forced exits are the gas in the tank for the market's next big move. Okay, so this is all great in theory, but how do we actually start thinking this way? Well, the source material gives us a super powerful but simple 5-step mental checklist that pros use to read the market's behavior in real time.
Now, it's really important to be clear about something. This is not some magic crystal ball for predicting the future. Not at all. It's a way to systematically figure out the probabilities. The whole goal is to figure out which side of the market is in pain right now, which side is under pressure, and then align yourself with that reality.
So the 5 steps are pretty straightforward. First, and we've seen how crucial this is the news versus the price reaction. Second is looking at how the market opens. Third, and this is the big one, is constantly asking who is trapped. Fourth, you're monitoring the volatility. And fifth, you watch how the market closes to see what the big money is setting up for the next day.
All right, let's dive into step 1, because it's probably the most important of them all. News versus price reaction. Just look at this table. Good news comes out, but the market, it falls? Whoa, that's a huge bearish sign. It tells you institutions are using that good news as a cover to sell. And on the flip side, horrible news hits and the market rallies? That's an incredibly bullish sign. It means the sellers are completely exhausted.
And this quote right here just perfectly sums up the entire philosophy behind this. The market almost has a mind of its own, and it tends to move in the one direction that will cause the most trouble for the most people. It sniffs out where everyone is comfortable and then moves against them, right towards the point of maximum financial pain.
So when you put it all together, what are we really talking about here? It's about a massive shift in what you're even looking at. The game stops being about trying to predict the future. The real game is about observing what's happening right now on a behavioral level and reacting to that.
And man, this slide just lays it all out side by side. Beginners are glued to the headlines, their favorite technical indicators, and just, is the arrow pointing up or down? But the pros? They're playing a totally different game. They're watching the reaction to the news, they're constantly asking who's trapped, and they're figuring out who desperately needs that exit liquidity.
So if we had to boil this entire professional way of thinking down to just one single question they ask themselves over and over again every single day, what would that question be?
It's this, and it's so simple, but it changes your entire perspective. Who is trapped today? Is it the people who chased that morning breakout right before it failed? Or is it the people who panic sold the morning crash just before it ripped back up? Answering that question gives you the best possible clue for where the market is likely headed next.
And we'll end on this golden rule. That simple up and down movement of price, it's easy to get mesmerized by it, but it's often the least important part of the story. It's the behavior of the price, how it acts around news, how it behaves at key levels, and who it traps in the process. That's where the real information is. Understanding that difference is the real first step in shifting from a retail mindset to a professional one. It's not about being a psychic. It's about being a detective.